Welcome to the Rosenberg Roundup, a weekly podcast providing investors with key macro and market developments, insightful data analysis, and actionable ideas that are top of mind for the Rosenberg research team in the week ahead.
Welcome to the Rosenberg Roundup. I'm Dylan Smith.
And I'm Jacob Rosenberg. We're going to keep the intro tight today because the latest GDP numbers just dropped pretty recently. I'm excited to have you kick off our first segment today by breaking that down for us.
Looking forward to it, Jacob. It created some interesting market dynamics, to say the least. We're also going to touch base today with some of the themes driving markets more broadly as we look back on the week that was. And in the spotlight today, central bank gold demand. You asked us how much more demand can come from the official sector, and we answered.
As usual, let's get started with the week in review. We got the first release of Q1 GDP on Thursday morning, and it came in weaker than expected. Let's get you to start there, Dylan.
That's right. The downside surprise we've been warning about did materialize, although it could have been worse. Expenditure was up by 1.6% in real terms, and that compares to 2.2% or higher on economist polls. Of the 88 forecasters polled by Reuters, only 3 were at 1.6 or below, so this was a big surprise. And it's a big change in direction from what we saw in the very hot Q3, Q4 prints towards the end of last year. I said it could have been worse, and that's because the segment that we were most worried about from our forecasts, which was investment, private investment specifically, actually outperformed. So we saw physical investment in plant and equipment come in pretty weak, basically flat. But it was the impossible to forecast intellectual property investment component, which is actually quite a large share of GDP, that showed a massive acceleration basically coming out of nowhere. Could well be picking up on the flurry of AI research that's underway, but very hard to tell at this point in the advance release. The major source of weakness was a slowdown in consumer spending, which has started the year very weak in the first 2 months, although we thought we saw an uptick in March, which might have led to a slightly higher number. That didn't materialize. There was also a big drop in net exports, which was predictable from the trade data. But all that said, the piece of information that markets really responded to was the price deflator for Q1, specifically on personal consumption expenditures, which came in at 3.7% Q-on-Q analyzed, significantly above expectations. Given that we have January and February PCE inflation data already, that basically told us that the March monthly print is going to come in super hot, and that's going to drop shortly after this podcast releases on Friday morning. That led to a big sell-off in bonds and another round of pushing back Fed cutting expectations. We're now priced for the first Fed cut all the way in December, and if you think that we started the year with 6 cuts priced in for the year, and now we're just at 1 at the very end of the year, that's a pretty shocking move. We should always couch the advanced GDP release number by saying that it is prone to very large revisions, most famously at the start of downturns. Usually you get positive numbers even after a recession's already started. So it should always be taken with a bit of a grain of salt. That said, we don't know which way it will be revised necessarily, but something to keep in mind.
That ties up our commentary on this week's data. Let's get you to tell our listeners what else you have in focus this week.
Well, let's linger on the market picture a little bit and focus in on U.S. equities, because we're at a very interesting spot, I think, right now. Equities certainly didn't like the GDP number. They didn't like that growth was lower. They didn't like that interest rates are probably going to be higher as a result for a little while longer because of those inflation numbers refusing to come down. But even ahead of the GDP release, the market had pared back some of last week's losses, but the S&P 500 was still down around 4% from the beginning of April. And one simple but very powerful tool that we use to look at near-term prospects for the market is our equity momentum model, which basically looks at measures of prices, earnings, volatility, and incorporates also credit spreads and broader financial conditions. And it looks at those relative to recent averages to give you a sense of, what momentum is kind of pushing prices in the short term. That's been flashing a green light continuously since November, but this week it shifted to a neutral reading. So on that basis, at least, it does look like the relentless rally has topped out for the time being.
And I know we're in earnings season, so how does that tie in?
That's right, Jacob. And our colleague Bhavana Chabra, our star equity analyst, has been pointing out for some time that this is an important juncture for markets. There was very little holding back the rally before earnings season, But this was going to be the big data dump that was going to reset kind of where we go from these levels. And worth bearing in mind that going into earnings season, a strong set of earnings, and especially a strong set of forward-looking earnings projections, had been implicitly priced by markets. What we've seen so far, though, is a bit of a mixed bag. Aggregate earnings are a little over projections at the moment, but mostly because the banks had a very good quarter. Turns out bull markets are still a very good thing for trading rooms. Even tech hasn't quite been uniformly positive, as we've seen in previous earnings results recently. You could contrast the chipmaker Texas Instruments, which absolutely blew the lights out, with Meta, who let a bit of air out the AI balloon by saying that it would take some time for AI results to show up in revenues, but in the meantime, it was doubling down on spending, and markets didn't like that much. And in general, it's been a bit of a torrid time for superstar tech stocks lately, with semiconductor producers like ASML and Taiwan Semiconductor and ARM and Supermicrocomputer all taking a bit of a breather after a rough week last week. Overall, the forward-looking guidance, which is going to be very important for where markets go for the rest of the year, has been pretty soft. Consumer-related stocks are not sending a good signal. Kering SA, which owns Gucci, among other brands, is seeing a huge drop in demand, mostly in China, but also globally. And the fact that Visa's earnings have held up nicely tells you that consumers are still flashing their credit cards as a way to continue funding expenditures. We'll have to wait for the big retailers later in earnings season, the Walmarts and the Amazons of the world, to get a real sense of the consumer story. But if you combine what we're seeing so far with what we've just seen in the GDP data, it does feel like we're at an inflection point for that supposedly bulletproof American consumer.
Is there anything else that you wanted to comment on before we move on to the next segment?
Sure. Switching gears a little, I just want to give the Bank of England props for leading the way on private markets scrutiny. I've long had a pet theory that the next big downturn will be triggered by a crisis in the extremely opaque but highly financially interconnected private equity and private debt industry. And we've written on those risks before. Those funds are using more and more leverage and leverage on leverage to deal with a trio of challenges posed by higher rates, lower multiples, and increasing difficulty offloading their investments. But this industry isn't closely monitored like investment banks are, so imbalances could build up almost to breaking point before anyone can step in and take notice. New Bank of England Financial Stability Chief Nat Benjamin made a great speech on Monday in which he basically announced it was his mission to get tough on the industry. That was followed on Tuesday by a letter from the Bank of England's Prudential Regulation Authority to UK banks, warning them that their risk management in relation to private equity and private debt is inadequate and requires a review. And we hope the Fed is watching closely to the benchmark being set across the pond.
That wraps up the week in review. Before our weekly spotlight, let's get a quick update from you on the week ahead.
Well, it's a big one next week. There's really not much time for the markets to digest the GDP numbers because, as we said, we'll have PCE dropping Friday today. We have consumer confidence coming in next week. We have job vacancies data. And then we'll finish the week with the big one, non-farm payrolls.
So let's turn to the spotlight. The gold rally, it's been on pause for the past week or so, down to around 2350 from the peak of 2400. My question for you, Dylan, is it time to let go of the 3000 target that we have?
Absolutely not. Remember, that's a longer term view, right? This week, after the big appreciation in the dollar and further commitment of markets to higher for longer, that was just too much for the gold rally to handle. So despite the fundamental sources of physical gold demand remaining strong, we had some headwinds for gold. It also looks like speculators in Asian markets have paused to take some profits, and that's put a bit of a top on the rally for now.
I think it's especially pertinent that this week we're putting a spotlight on your recent piece on central bank demand, where you highlighted that as an important underlying source of demand. We actually received a question from a few of our clients as to how sustainable that source is. How would you answer that?
Well, let's just take a minute to look back on what central banks are doing in relation to gold and why. Now, gold has always been an important reserve asset for central banks. They hold it, among other reserves, against their main liability, which is cash in circulation, right? Now, most countries are all for gold standard and have been for a very long time, so it's not like there's a one-to-one backing, and central banks can and do hold other assets, primarily government bonds, US dollars, and other currencies. In fact, in the early part of the millennium, banks were pretty rapidly selling down their gold reserves because it's a bit of a pain to store. We're in a phase of massive globalization, and banks were favoring dollar and even euro and Chinese yuan holdings instead. That went into reverse after the global financial crisis, when emerging market central banks in particular, led by China, started restocking up gold on the realization that physical assets actually had their uses in a very volatile economic and financial environment. Remember that there were fears at the time that the euro, which is an important reserve currency, especially for the kind of European periphery, might actually cease to exist. China at that point actually had almost non-existent gold reserves, at least in relation to their other reserve holdings. So, it wanted to diversify into gold purely for that reason too. But more recently, the reasons to stock up on gold from an official perspective have intensified. I think the COVID pandemic reminded everyone that global interconnectedness can be disrupted, so it pays to have physical reserves in country. China wants to decrease its reliance on U.S. treasuries and dollar reserves as, the great friendship between the two countries cracks up a little bit. And central banks in Europe, especially Poland and the Baltics, are stocking up too. They're feeling a little skittish about Russia and its ability to disrupt trade and finance.
Would you say it's all done?
No, it's not all done. Central bank gold buying programs, they tend to be stretched out over time to manage risk. They have to transport the gold. They want to smooth through price volatility. So the demand we've seen building up, of course, will just continue on that basis. Buying plans take a while to be enforced. The underlying drivers of gold demand, in any case, which is basically geopolitics and polarization, those are big structural shifts that aren't going anywhere, we don't think. So we can run a few basic calculations just to show how important central banks are for gold demand and the degree of pent-up demand that we think is still out there, right? So look at China, probably the biggest gold buyer recently. China's gold reserves are only at 4.7% of total reserves, right? And that's against a global average of more like 13%, right? And other very big central banks actually hold way more than that. So if China increases reserves increases gold as a proportion of total reserves by just one more percentage point, they would actually demand 11% of annual gold mine production, right? And China isn't the only buyer. If more central banks see the trend happening in terms of buying gold and think we should top up a bit too, or we should at least stop selling, there are some sellers still out there, and say, a very plausible scenario that total gold as a share of reserves, moves up another 0.5 percentage points, that would basically mean that central banks were gobbling up 50% of new production. So official demand is persistent, it's massive in scale, it's very important, and it's a big structural tailwind in the sales of gold price for some time.
That wraps up this week's Spotlight, and since there was nothing worth reporting on in Canada this week, I think it's time for us to sign off. I'm Jacob Rosenberg.
I'm Dylan Smith, and that was the Rosenberg Roundup.
Thank you for listening to this week's episode of Rosenberg Roundup. For more information on our work and to take advantage of a free 30-day trial of our research, please visit rosenbergresearch.com. Make sure to tune in to our next episode for more insightful analysis on the macro and market landscape. Rosenberg Roundup is provided for general information and entertainment purposes only and does not constitute legal or professional advice, nor is it an offer to sell or a solicitation of an offer to purchase any security or derivative. Any views expressed by the participants of Rosenberg Roundup are solely their own and do not necessarily reflect the views, opinions, beliefs, or policies of Rosenberg Research.